Just a quick update from here at Fortress on the goings on in the investment world since the last time we updated at the end of the second quarter. Q3 is about half over now, and we are in the middle of August. Stock markets so far have been mixed. Some of the stocks that led the market stronger in Q2, the most expensive growth stocks, really came off the boil so far, and the kind of boring stocks that we invest in have done reasonably well, held their value quite well. Bonds as well have been improving, prices going up and yields coming down. One of the main reasons for that has been that there's a clearer path now to interest rate cuts from the US Fed. They've been one of the holdouts of central banks globally, responding to more weaker economic numbers. With rate cuts, the Fed hasn't cut yet, but the market now expects them to cut by at least 0.25% at their meeting in September, and maybe even as much as half a percentage point. We do have an economic slowdown of some sort going on globally and in the US. It doesn't mean there's a recession, but I think it does mean, and we should be prepared to read about, hear about bits and pieces that are weak, as well as bits that are a bit stronger. One weak data point today came from retailer Home Depot. They said they're seeing among their customers a quote unquote deferral mindset, and they think sales are going to be down 3 to 4% this year. That means slow down. But it's not slow everywhere, and there are many companies that continue to do just fine. And in fact, even at a lower level of sales, Home Depot continues to do just fine. But the kind of boring, steady companies that we invest in our US funds and about 2/3 of the Caribbean Growth Fund, we're looking for resilience in both operations as well as valuations. And valuations, the price that we pay to own the shares to be reasonable. Last Monday, there was a pretty big move in the Japanese stock market. And by extension, then it spilled over into other global markets, a huge drop of about 12% in Japan. It looked a lot like profit-taking, unwinding of profitable positions on things that had gone up a lot, including some technology stocks. Already those stocks have been coming under pressure in the US, but it did feel like an unwind. And since then, markets have recovered. Everything outside Japan has continued to do reasonably well. And even Japan has recovered a fair bit of losses. What we're seeing, though, in the last few weeks has been some other things like that, too. Some violent moves, rotations out of one sector or type of stock into another. I mentioned that the expensive large growth stocks have been coming under pressure. A couple of days in July, we saw big moves out of those and into, again, steady, boring, well-valued stocks. So a bit more violent than we would have thought, but this is a trend that we would not be surprised to see continuing, both within the US market as well as outside the US, as investors gradually take profits on some of the overvalued areas and put money into some of the better valued areas. We see good return potential in markets outside the US and even in some pockets in the US. And we continue to think that bonds with yields around 4 to 5% offer pretty good protection as well as return prospects. And that's it from here.